Property prices are falling in parts of Australia at the same time as rents are rising. How can that be happening? The answer is really quite simple. No two markets behave the same way at the same time, and we really need to understand that property prices themselves, median prices, the transactions of buying and selling, and the different groups of people that do buy and sell properties are not the same people as the people who are renting properties, those that are looking to rent them out, those that are looking to occupy them. And different factors influence decisions around how people behave in these markets. So it is really possible for rents to be rising while property prices are falling.
One market is being squeezed by things like borrowing capacity, sentiment, tax changes. The other part of the market, the rental side of the market, is being squeezed by supply. And so you can have fewer people prepared or willing or able to buy while still having more people competing to rent. At the end of the day, everyone needs a roof over their head, and you have this mix of investors and occupiers in the market. And on the occupation side of things, owner occupiers, but also renters. And so you've got different sets of needs, different sets of dynamics on both sides, and you can have these opposite trends, this seeming contradiction that, well, surely if rents are going up and supply is tight, prices should be going up as well. And yet what we're seeing is broadly the opposite of that right now. It makes for some interesting headlines as well, Brendan. Apparently, I read in the news today that Australia's housing boom is over as of
Really?
today. Now, when did that
Really?
happen?
So what? Yesterday we were booming and today we're not? Fascinating. I'd like to suggest that transition has been happening for a while. In fact, I'd like to suggest that on the Property Pulse, for those who may have been watching these over week in, week out, and if you have, fantastic, this would have been identified something like, oh, let's call it 6 months ago. Um, for those who are joining us for the first time, welcome. It's great to have you here. But as a heads up, yeah, we kind of picked that would be the case. That the boom has been over for some time. So let's talk about that a little bit. Well, what is happening in the broader property market relative to median price movement and sales? Sydney's in decline at the moment, and it's in decline fairly sharply. The rate of decline right now is around about 14% per annum. Now, that's unlikely to be sustained for a year such that it's a 14% drop, but at a rate at the moment is around 14% per annum. Melbourne's rate of decline right now is around about 10% per annum. So they're kind of stressed markets at the moment. Brisbane's just peaked and started to come back. Adelaide's just peaked and started to come back. And Perth is in a state where there is just nominal marginal growth, and in fact may have peaked in the last couple of days. No two cities are behaving the same way. How dare they? And as a consequence, you've got different markets right across the country. So the reason that we've had it declared that the boom is over is because the latest quarterly statistics came back and said this is the first time in a quarter that we've seen negative growth over a 3-month period. The boom is over.
There's a real mixed bag even beneath that headline. Yes, national dwelling values have fallen based on the latest data to the end of June. You still have some cities where in aggregate that city has risen in value. So it's by no means across the board, but it makes for a great headline, doesn't it? That the boom is over, even though, as we know, those trends have been somewhat entrenched for some time.
Now, the flip side of this, of course, is, well, what's happening with rents? Asking rents are continuing to rise, and that's on the back of a severe shortage in stock. Typically, and pre-pandemic period, if a market, an area was at around about 3% vacancy, you kind of got a flat, not a lot of growth in rent, but it's 1 point something percent is the vacancy rate at the moment. It's really tight. And as a consequence, there is a shift in rent prices. Now, if you add to that, funnily enough, a policy change by a budget that says, you know what? We're not going to encourage investors to invest in established houses anymore. We're going to encourage investors to buy into new properties to help them promote the creation of new stock. Fantastic. The consequence is those people who are traditional buy and hold investors in established areas won't do that anymore because the incentive doesn't exist. Some of the benefits that were there, negative gearing, are not there to the same extent or not in the same way that they were. And as a consequence, you've got a certain exodus of activity by investors in established areas.
Yeah. And when we talk about the sort of exodus of activity, what we're not talking about is an exodus in the sense of investors just throwing established properties back into the market and selling them down. That's
Correct.
not happening. And
Correct.
that's highly unlikely to happen because those investors may, in fact, right now be enjoying some, tax benefits, negative gearing, and so on, which they retain on those properties as long as they hold those properties. So there's a disincentive, if you like, for them to just cut and run and dump those properties into the
Correct.
market to increase the available listings or supply of housing in these established areas. But in the absence of as much incentive for investors to buy established houses in those areas and turn those houses, if they bought them from an owner occupier, into rental accommodation, then you will have this attrition over time in terms of the available rental stock relative to the volume of people that want to rent in those areas. And with population pressures, with just the fact that these are established areas and there's plenty of reasons people want to live there, there's limited infill happening in those areas. So you can't create an awful lot of new housing supply in a lot of these suburban areas. The inevitable result for that is that increasing pressure from demand on a static, in fact, declining supply of established rental stock in those areas over time, isn't it?
It is, absolutely. The upshot here, you've got a scenario where you've got falling prices and rising rents. And the question is, well, how can that be? And it's the one event, the budget change to negative gearing and the incentives for investors that has caused and is the primary source of this change. Why?
In terms of housing ownership, 1/3 are investors and 2/3 are owner occupiers with or without a mortgage. Yeah.
You take about a third of the market out of the established suburbs, of the established property market, and shift it into new or shift it into panic, in which case they don't do anything. So you've got a scenario where you've got less buyers interested in securing property in established areas. With that lack of interest and lack of competition, you start to get increased volumes of listings, increased supply, and decreased buyer demand, therefore prices fall. Funnily enough, look at that. There was a news item today. The boom is over. And that's the natural course of events on that. But you take our previous conversation about the rent stock, and you've got, less properties to rent, tighter competition to rent a house. Rents go up. What we're seeing is exactly what was either planned or as a consequence, maybe not planned, a consequence of the change.
Yeah. I don't think this is any kind of plan. I don't credit the authorities in
You make a fair point.
really having thought this through that well. I mean, we saw the so-called modeling that came out of the budget with this idea that rents in aggregate nationally might go up by $2 a week, and yet right now what we're seeing is rents at record high levels and a tightness in the rental market that is tighter than what we had predating COVID. So this has been building, I think, for some time in terms of that tightness in the rental market. These changes and the way in which they're influencing investor behaviors, so you've got fewer investor purchases happening in these established areas where people live, work, play. Is that helping in any way the
Not even
available
close.
rental stock? And you've got to say, well, no, it's working in
Makes it
the
worse.
opposite direction. It's supply suppressing whilst the demand is still there and in fact growing.
In 2021, we had a genuine exodus of investors when interest rates were near zero and property prices took off. In 2021, pretty much across Australia, a lot of investors said, you know what, this is a good time for me to exit because they were nearing retirement age, they were looking to cash out, and a lot of investors sold up. I think we lost 100,000 investors and 120, 150,000 rental houses in that market. And that was the trigger for a significant shortage of stock and a changing of the percentages of vacancies that we were used to. This is not contributing to the recovery of that.
Yeah, and just as an aside on that point where you had a lot of investors selling up, who bought those properties? Owner occupiers. And this is something I think it's often glossed over or even completely missed in the analysis, certainly by the politicians and frankly by many economists as well, is that, you know what, 2/3 of the market are owner occupiers. It's not just investors that are driving prices. In fact, in that exodus of investors, the price pressure was owner occupiers that drove up the
Yeah,
prices. And we've
absolutely.
seen this in the past in times like, for instance, when lending became much tighter and the servicing buffers went up and there were lower LVRs available to investors, property prices went up despite the reduced activity of investors. Who drove those property prices up? Owner occupiers. So you got to look at this stuff holistically. You can't focus in on just one little niche and think you're going to somehow solve affordability. And you're certainly at the moment, with the way the policies have been constructed, not doing anything for rental affordability, I think.
If we've got a scenario right now where there are fewer rental stock, smaller volumes, we've got tightening demand on rent, we've got an encouragement of investors not to buy established properties. Are we screwed? Like, are we as a population stuffed for eternity? And I'd like to say no. Investors bought properties where the rent wasn't enough to offset the costs, but with the tax incentive, people could tolerate the out of pocket hurt with their other income. So there was an equilibrium. They acclimatized to, I need to be out of pocket $100 a week in order to own a property and have it go up in value over time. The real benefit is the property price growth. It's not the cash flow anyway. I'll take the cash flow hit because I'm employed and I can afford to and accumulate my properties over the years to give myself a better retirement. Fantastic. That model still works, just less effectively at the moment because the cost out of pocket is less tolerable. And there will come a point with these rent rises and price falls where the differential is enough then for an investor to go, oh, this I can tolerate, and then start to buy established properties again.
So do rising rents then, Brendan, in your mind, create an investor opportunity?
In time. So typically people would be out of pocket 1 or 2 percentage points of the value of the home, 1 or 2 percentage points, and tolerate paying that. If we've got rents of about 2% coming in inner city areas and those desirable areas with interest rates of 6%, you've got a 4% discrepancy there that people go, I can't afford that out of my pocket. That's going to hurt. But around 1 to 2% is what people can afford. So when we get to a point where yields improve by about 2% on what they typically are, then you're going to get people assessing the buffer of what out of pocket expenses are. Can I afford it? I think I can. And then start to move back in. And there will continue to be the third of the population not buying established properties will start to move back into buying established properties again as investment properties.
Now, you mentioned the increase in rents or rental yields as being part of the driver here to re-energize potential investor interest, and we're talking about, you know, the broader investor population here. But if you've got the combination of forces, so rising rents and falling prices, then the falling prices also act to increase the yield effectively,
Correct.
don't they? So that combination, it's not just a question of rents going up, but as prices ease and rents go up, you kind of get there a little bit faster, don't you?
Correct. So if you had prices held flat and we were waiting for rents to rise, my calculation suggested that it'd be about 4 to 4.5 years of gentle rent growth over a period of time to reach that buffer that the yields would be enough for investors to consider established properties again because they can afford the out of pocket expenses. But if prices are coming down and continue to come down, then you might reach that in as little as 18 months or maybe even 2 years. Now, you and I have talked about the past about property price crashes where they've gone down and immediately back up. Yeah. This is not going to be one of those circumstances. We are seeing an easing and there will be a bottoming out over a period of time. But there will be a gentle growth from that point until such time as there is a saturation of interest, in which case then you're going to see prices really start to take off again.
Given the pressure on rents and the fact that rents are going up in many parts of the country and in areas where prices are softening, if investors listening to this are seeing the yields going up in the area, should they be diving in and expecting that, just because rents are going up, they've got a great investment opportunity?
No, not every property, just because it's got a great yield, is going to be a great purchase.
That's a really important point, I think, here. I can have a high yielding property. I could have a residential property in a certain area that on paper is getting a 10% yield, which might sound great. But if it's vacant for 3/4 of the year, it's not so crash hot, is it? So we got to do some due diligence here. We need to understand not just the rental return on paper, but what are the true outgoings on this property? Does it have hideously high body corporate fees, for example, or a large maintenance cost ongoing? What is the vacancy risk? What's the risk that there's going to be a flood of other rental properties? A la if I'm, buying into a greenfields estate area and looking to rent out my house, and there are dozens or hundreds of other investors that might also buy in there and put their properties up for rent, what's that going to do in terms of rental returns and growth over time as
Well,
well?
that
So we
leads
need.
us to a very interesting point, Simon. If people are not, investors are not buying and have a high demand right now for established properties, where are they driven to go? They're driven to go where negative gearing is still available and the borrowing capacity is available also, meaning new stock. Now, the whole incentive of the budget was to drive activity towards new stocks so that it supports the production of new housing. Awesome. But does that help the people it's designed to help, first home buyers? Is that actually going to work supporting first home buyers?
Am I allowed to get on my soapbox for a few
Please, you're
seconds?
more than welcome at this point to do so. Yes.
So we had all the messaging coming out of the budget that this was all about addressing intergenerational inequality and making it easier for first home buyers to get a foot on the ladder. And there's a lot of people that would take the view that falling prices are a positive for first home buyers in terms of helping them out. The problem with that approach and the problem with the very piecemeal approach that we've got with policy is that if you're not looking at the problem holistically and actually understanding these different dynamics and these different parts of the market and what drives each different segment, you can have prices fall but not actually improve affordability. Now, what do I mean by that? You can have falling prices, but we've had rapid succession of interest rate rises this year, which means that the servicing ability for anyone going out to get a loan, first home buyer, investor, whoever, their borrowing capacity has fallen faster this year, potentially than the speed at which prices are currently falling. So you've got a little bit of a disconnect there in that my loan affordability is reduced, even if the price is reduced, and it doesn't necessarily balance out. Those higher repayments can offset a modest discount in price. But that's not the biggest barrier to entry for first home buyers or for most buyers in the market. The biggest barrier to entry is typically the deposit. And sure, we've had the first home buyer 5% deposit guarantee scheme that came out some months ago that was designed to reduce the amount that first home buyers might need to put up to get in. So that's one thing. Although, as we've seen and as we've talked about in past property pulses and webinars, what that did was just drive prices up in the lower quartile of the market. So you didn't really have falling prices, you actually had increasing prices. But you've got the issue that even with that, I've still got to save that deposit. And if my rent is going up, if I'm currently renting and I aspire to be a first home buyer, but I'm currently renting, my rent is going up, is that making it easier or harder for me to save a deposit? Clearly, it makes it more difficult for me to save the deposit. It's going to take longer. And if that strong rental competition persists, it just means that people do stay trapped in the rental market longer. So one of the key pieces that's missing in this puzzle is how do we improve the availability of rental stock to make rents more affordable so that people who are trying to get on the first home buyer ladder are able to save more effectively. And there's absolutely nothing in the budget that helps address that. In fact, the policy to discourage investment in established houses in the areas where people actually want to live and where they're going to rent works against that. And actually, it makes it more difficult, not easier, for the first home buyer to get into the market, I would argue. So we have this situation where even if you've got falling prices, with skyrocketing rents, property's not becoming more affordable or easier to get into.
Now, if you then direct people to their greenfield estates and force populations out there, there's a certain contrarian position, Simon, in that investors go out there, they go and buy the stock, which means there's competition on price for first home buyers anyway, so prices go up. On higher interest rates, that's going to make it a little bit tougher. You got a 5% deposit scheme, which makes it a little bit easier, which is great, but you're out in the sticks. And if you're competing then with investors who have a greater borrowing capacity, again, prices get driven up. Two things can occur there. One, if we continue to see general price decline and first home buyers have bought on a 95% deposit scheme and prices do come down, there are going to be a lot of first home buyers in a negative equity position. In the 5% fall is not impossible to achieve, particularly in these circumstances. So they're bound to their houses because of the loan with a value that is less than what they bought it for. Consequently, they're negative equity. So there's a risk in that. But also, the stock that's available and being built out in the greenfield estates for first home buyers being bought by investors mean that the stock that is available for them is less.
Again, it shows, I guess, coming back to my point about if you don't approach this holistically, you'll screw it up. And you won't provide a long-term solution to any of these issues around housing supply, housing affordability, and so on. And so we've got to get away from the sort of piecemeal, knee-jerk reaction, political football style approach to housing policy, and actually get sensible minds together looking at the problem as a whole rather than trying to attack little bits here and there and then just making a mess of it, I think.
Getting off our soapboxes right now, let's close this out. The primary objective here is make sure you do your investigation on the property that you're looking to buy, look at the local statistics. Sure, there are overarching indicators going on in the broader market, but you need to do the analysis on the property that you're looking to buy relative to the strategy you're looking to take on. Don't just pick anything because you think it's an opportunity because prices are coming down right now. Don't pick anything just because the rent's going up and you think, oh, I'm in with a great prize in the not too distant future, because that may not work out either. If you're new to the community, welcome aboard. It is a pleasure to have you. If this is the first property policy you've seen, welcome aboard also. It's been a pleasure to have you join us in this. Until we meet again, invest wisely. See you next Thursday. Thanks, guys.
See you, everyone.